I wasted so much time chasing things that led me no closer to being profitable or ever consistent. But I kept telling myself, doing these things will get it. And it never did. Until I woke up and listened to the advice that I felt God tell me to say, look in the charts for when it continuously repeats these types of things. Look here. Look here. That's what I heard. Sometimes it was audible. Sometimes it was inside my spirit. Like sometimes it was my own internal voice. And it sounds crazy if you don't have any faith in him, but that's how it worked. That's how it happened. And I started looking for price runs that would occur at the open at 9:30 for S&P. When the currencies would open up, 'cause I traded currency futures, not forex. I didn't really gravitate to full forex until 2006. I traded forex a little bit earlier than that, but I didn't touch it completely and 100% leave everything behind until 2006. But I was a futures trader, a commodity trader in the beginning, and I got real comfortable trading currency futures, Deutschmark, Swiss franc, yen. I loved the yen back then. I hate yen now. British pound, Canadian dollar, all that stuff, all the com dolls. And I loved them because they had a gap opening every single day. Every single day. And you've seen what we've been doing with index futures with gaps, right? Apply that same logic to currency futures, not Forex, currency futures. And you'll see similar things are there. There's a price run that always took place at a very specific time trading bonds. And once I discovered that, I locked onto that and said, I don't care about currency futures. I'm a bond trader. I'm a bond trader because I saw something in that market first as it relates to time. And I said, well, if now I didn't do it right away. It was months and months in the first year of me doing it. I was like, wait a minute. I'm talking to my uncle and I'm telling him, I said, Uncle Stan, like I got something in bonds. It's just so good. But I'm afraid to talk about it because I'm afraid if I talk about it, I'm going to jinx it. And he's already proven it at that time. He's not interested in listening to me because he wants to be a contrarian. I'm buzzing on this idea that I got something that nobody else has talked about. No one else talks about this. I was even afraid to ask Larry Williams by writing to him and saying, listen, do you, because I was like, maybe he doesn't know. And if it's really, really good, he'll treat it like he did with the turtle stuff and he'll teach it. I didn't want to share it with anybody. I was like, this is so good. I don't want to share it with no one. And I said, you know what? Let me see if I can start doing that same thing in my previous favorite markets, the currency futures. Wouldn't you know it? It's right there too. And I'm like, what in the world? How did this escape me? All this time I'm looking at 50-day moving averages and stochastics, five by three smooth on a Williams percent R and stochastic when they agreed it was overbought, oversold, but the divergence occurred in one or the other. It doesn't matter. It didn't. Both of them didn't have to diverge for me. But when they were oversold and one of them diverged bullishly, the next day I'm waiting for the open, and I'm waiting for it to go down below the opening, and I'm going to buy it on a stop as it goes back above the opening price. That was my methodology then. That was the very first inner circle trader. You know, this is my step by step. I'm not thinking about it. I had to have a mechanism like that to get me in because I couldn't be in front of the phone constantly call the orders in. So I had to put resting orders in, but I had to get that opening price, and I could get that on the Quotrek. As soon as it popped up on the screen, boom, I got my opening price, and then I watched and see if it started trading lower. If it went lower when I was looking to go long the next day, and the next day is what I'm looking at in the charts, not the charts, on the Quotrek, on my truck, I would already have the phone number from my broker in my hand, running to the payphone, because that's how we did things back then. I had to have quarters in my pocket, run to the payphone, or if I'd run into an office building and I was doing the delivery for the snacks and cakes and whatnot, I would ask somebody, look, can I borrow your phone real quick? I got to call the office. And yes, I was lying back then, okay? But I was desperate. I had to get the orders in. So I'd call, had to wait for them to answer the phone. Lynn Waldock, yes, H desk, please. Oh, 1 second. The whole time the market's moving around. Imagine doing this today with the volatility. It's nerve-wracking. But you place your order, buy on a stop above the opening price. Stop loss is, back then I could tell the broker, whatever the low was, that's where I want my stop, one tick below that. That was my mechanism. I could only afford one contract. I was trading mid-AMs, which is kind of like the equivalent of a half a contract for today. Like we have mini, and then we have micros, which is 1/10. Well, back then we could trade mid-AMs, which were like half the size of the full-size contract. And then I'd watch and stress about it all day long. And in the last part of the day, it would flurry and move in my direction. And when I was right, and I was like, yes, woo! Do my Ric Flair strut, coming out of the truck, getting into a new office building to get my inventory. I got to fill back up in the machine. It was fun. It was fun when I was winning. When I was losing, it sucked because when I lost, I felt like I wanted to throw everything away. But the time-based aspects of what I was doing right, that has never, ever escaped me. I've never turned my back away from that. I've had entry strategies I've created for myself, and I've abandoned them. I've had full-blown trading plans that I've abandoned. But I've never, since discovering these very systematic time-based price runs that occur in price action every single day, every single week, in every market, I've never left it. And last year and this year, I've been teaching it slowly. I've been revealing a lot of those things to you. Some of them, well, you saw in the silver bullet. As soon as 10 o'clock forms, all you need to know is what direction it's moving. Now, no, some of you obviously stress about this. You make it so hard when I've already taught how to do this. You want an everyday bias that's 100%. And you're not going to get that when you're first learning. Learning from me while I'm calling the market, you can get an intraday bias that's pretty much almost as close as perfect, but still yet not perfect. So you're building in no allowance for doing it wrong. Even if you have strategies like I have that are very specific time-based runs, knowing for what liquidity it's going to reach for, but you're demanding perfect. You're demanding perfect. You get caught up when I say, look how the algorithm delivers perfectly. That's not me saying, look how you perfectly traded that bottom tick, top tick, and you got nothing left on the bone. That's not what I'm saying here. But because you're young as a trader, and you're very, very influential, and you're very subjective about what you listen to, you only want to listen to the good sugar-coated stuff. You ignore me when I tell you you're going to lose money. You ignore me when I tell you you're not going to be perfect. It's going to be hard for you. You're ignoring all that. And the ones that do really well, and by the way, again, round of applause for Kyle. Another monster, like I told you. Team, Kyle, and who else is going to publicly come out? ICT stuff don't work, bro. These concepts, this is going to lead to you knowing what to do and when to do it. But that silver bullet, if you know what the bias is for that session, you don't need to know it for the day. Throw that out for right now. You learn that over time. How do you know what the session bias is going to be? Well, how did we gap open? Did we gap open? What liquidity did they leave in pre-market session? That means 7 o'clock in the morning to 9 o'clock, 9:30 in the morning opening for equities. If you're trading Forex, between 7 o'clock and 9 o'clock. Very simple little windows. And you're looking for these periods of where there are smooth highs or smooth lows, because that's where the market's going most of the time. Not 100% of the time, 80% of the time, we'll call it that. Call it 75% of the time. Oh, that ain't good enough. 75% of the time, it ain't worth my time, ICT. We ain't got time for 75% around here. If you can't get it up higher than that, there's rookie numbers. We got to bump them up, or I'm going to move on to somebody else. Go. Don't let the door hit you in your ass. Goodbye. Laziness doesn't survive around here. But knowing that there's going to be a fair value gap every single day at 10 o'clock to 11 o'clock It's going to form, and it's going to give it to you on a silver platter before it runs to that session liquidity. It happens every day, and I challenge you all to not believe me and start looking for it. What? You watch other people prove they make money with it, but you've never really sat down and said, how often has it failed? That's what you were instructed to do. Because that's the stuff I walk on. I moonwalk on all these supposed professionals, these guys that I'm a so-and-so floor trader. I'm a so-and-so at blah, blah, blah capital. Bro, come out here live and I will sing a dance as these candlesticks go up and down to my music sheet. That's how it works around here. I'm the composer. I'm like Bugs Bunny. Remember that? He raises his fingers up and in the concert pianist and the concert, orchestra, they're out there trying to keep up with his intensity. That's what it's like. I'm the Pied Piper, and these candlesticks, they follow me. And that sounds arrogant. Yes, it does. And I'm okay with it. I'm okay with that. I don't care if you're not okay with it. The proof is in the pudding. The markets are going to gravitate to liquidity, but you have to know how to define that. It's session liquidity first. First and foremost, it's session liquidity. What does that mean? Well, the morning session, the afternoon session, the lunch macro. If it's going to retrace on whatever move it was in the morning, what's it going to be? Move against the trend that was happening in the morning session. Find the easiest low-hanging fruit low. If you can trade that and find profitability that yields enough of a payout for you, then take the trade. But there's lots of trades that pass me by all day long where they're only 10, 15, 20 handles. I could do them all day long. I don't care about them. They're constantly there. They're like a McDonald's or a 7-Eleven. They're on every corner. Drive down the road a little bit more, you're going to see another one. I'm not worried about them. I'm stopping at the bus stops like where my wife's standing there. If I see my wife standing at a bus stop before I met her, I'm stopping at that one and say, honey, you need a ride because I'll take you where you got to go. And you're going to enjoy the ride. I'm not slipping in Nick D's fast food drive-through. Okay, I don't slum it like that. I'm looking for the best setups. I'm looking for the things that make sense for me because I'm not a micro lot trader. I'm not a one lot trader. I'm in here trying to get something, and I want my time to yield to me a bountiful harvest. I want something that's going to be worth my risk that I put on, but also deliver gangbuster results. Like bang. Like Emerald Lagasse, remember him? He would just say, bam, put his spices on it. He was fun to watch. Otherwise, it was kind of boring. But when he did that, it was great. What's another one, ICT? We already know about the silver bullet. Okay, first percent fair value gap. It's going to form. It is absolutely going to form in the first 30 minutes. Or it forces you into a silver bullet at 10 o'clock. So what have I done? I've basically encapsulated that first hour trading between 9:30 and 10 o'clock. I'm sorry, 9:30 and 10:30. That first 1 hour trading I've been doing in front of you. Consistent, isn't it? Boom, boom, boom. Calling every candle. Boom, boom. Running to where I said I was going to go. Boom, boom, boom. Never missing a beat. Boom, boom, boom. All of a sudden, you start thinking to yourself, man, this guy's got his stuff together. Look at this. I mean, he's like consistently telling you where it's going to go. Yep. And you can do it too. I'm trying to tell you, I've already taught these things to you, but how much time have you spent working with it and blocking out everything else? That means everything else I've taught on my YouTube channel. Focus on one thing, folks. What happens if the first percent of fair value gap forms in the first 30 minutes? But price just keeps on running away and never comes back to it. Away? Just abandon it? Nope. Absolutely not. Wait till 10:30. 10:30 is that first hour trading. In that first hour of trading, you have the bulk of all this large influx of big conglomerate liquidity coming into the marketplace. It's shoved into the marketplace in the first hour. That's why there's so many opportunities for price to move around and gyrate. But after that first hour, if it's a trending day, it's obvious after the first hour. And it just continues and continues and continues until the close of the day. But as a trader that's looking for setups using the first percent of fair value gap, obviously, if you're bullish, you're looking for session relative equal highs. That's either going to form between 7 o'clock and the opening about 9:30, or London high or London low. You got two choices there. Which one has a relative equal high or relative equal low? Hello. Hot damn. That's easy. That's easy. That's really easy, isn't it? It completely removes the ambiguity, doesn't it? Now, you would have figured that out if you listened to everything I said to focus on per session. But because you're out there looking for the next shiny object that I'm releasing all the time, you're never spending enough sufficient time working with what I already taught you. Can you teach me how to do a bias? It's easy. I did it again here, and it'll go largely ignored. It'll go largely ignored. Nobody will look back and see how many times it tells you exactly what to do. But you're worried about, am I going to do a Telegram session? Am I going to ever do a live stream? Am I ever going to do this? Am I ever going to do that? I told you I could stop. You already have enough. But what happens if it keeps running? It never goes back to that first percent of fair value gap. In the first 30 minutes, a fair value gap that forms on that 1 minute chart that has displacement. It's obvious. It's showing itself, not some little micro. If it never comes back to it before it starts running, wait till 10:30, because you have the first hour trading behind you now. Between 10:30 and 11:30, you have now London close. ICT, we're talking about SPOOs, bro. We're not talking about cable and fiber, currency futures, and that type of stuff. We're talking about why does London close have anything to do with this? Because that's what markets do. They're coded to offer a retracement back down into a fair value. And that's how I teach you, and I've done it in front of you. You can't deny that. I've shown it to you, I've walked you through it, I've called it out in Telegram, and you've seen me trade it. Live funds, baby. Pulling back into what? First presented fair value gap. Oh, yeah. How about that? It doesn't have to be the springboard to put me in the trade. Sometimes it's going to run without me. I might be looking for that first presented fair value gap to get me on the trade. And the market says, not today, ICT. Okay. Okay. I got you. No problem. Do your thing. I'll be waiting for you when you get to 10:30. And when you walk yourself inside my crosshairs, I'm going to hug the trigger. And I'm going to drop you. And I'm going to take my profit inside that first percent fair value gap. At least the very first partial will come out there. If it's on a day where I think it's going to go lower, why would I want to see it do that? Because in London, there's relative equal lows down there they left generously. That retail's going to say, man, my stop is so protected underneath there. Ain't never coming back there until it does. Expediently. Daily highs and lows. Previous day's high or the last highs creates a swing high and then it plummets. And you're thinking, it plummets. And you're thinking, this guy is such a failure, blah, blah, blah. And it just goes down to something as a discount that I'm trading in front of you, calling it in Telegram, and then I'm running it up into that target. I love those setups. They place that swing high there just below a target that I know is a draw on liquidity, which is an old daily high, which is a previous week's high. No, that's not earth shattering. No, I didn't invent that. I didn't say I did. But all you yahoos out there that want to talk smack all the time, you literally don't do it because you're looking at something else and you're posting, here's my $700 win. Here's my $500 win. What are you doing, ICT? An annual salary. Just saying. Just saying. Swing highs that form just below or just above draws on liquidity that I've shared openly with you. Look at what I've been teaching you. Look at the ones I've shown you. Why have I brought them to your attention? They're fitting the criteria I'm outlining here. Previous week's highs and lows. That liquidity is enormous. It's enormous. They're all time-based setups. They're never going to hide the daily high from you that was yesterday. They're never going to be able to do that. They're never going to be able to do that. But in Forex, they can. Compare all the major brokers for Forex, look at GBP USD. They're never going to agree. They're never going to have the same high. They're never going to have the same low. That market, especially right now, has so many disadvantages versus the futures market. The futures market, everybody has the same high. Everybody has the same low. So that means every bit of liquidity that's going to be above the high is concentrated at that high price and just above it. You cannot have that same affinity in Forex because there's a disparity. And when you look inside how those brokers operate, they have smaller little pools where they're trading against their clients. I could show you that because I had brokerage accounts through GFT, which I don't even think they exist anymore. They shut me down when I mistakenly talked out loud when I was on the phone. I said, I was letting my son trade one of the accounts, and they're like, "What did you say?" I was like, "Yeah, I was letting my son. He was, I'm trying to teach him how to trade." And he goes, "Well, you're not supposed to do that." And I was like, "Well, just pretend you didn't hear it." And he finished the conversation with me, and immediately they sent me notice that they closed the account. Okay, but I found out because I had multiple accounts in that brokerage firm, those highs didn't agree. Just like FXCM, remember them trash brokers? Remember that trash broker FXCM? Same thing there. Multiple accounts, friends that were trading too. Their highs are different from mine. I'm like, what in the world? Wow, that's way different from what I got. You don't have that problem when you're trading futures. NASDAQ's high is NASDAQ's high. But having that pool of liquidity, it's stated you can take with that. And you don't even need a bias. You don't even need a bias. If it's in close proximity to a new week opening gap high or low, and it creates a fair value gap that's bearish and the new week opening gap's lower by 20 handles or a little bit more than that, you have an easy bread and butter setup right there. Oh man, it's easy. That's easy. At the end of this year, I'm going to give you a challenge going into next year. Don't do it now. Next year. I want you to try to go into the day with a demo account and always be in the market. You got one contract, micro contract. And I want you to constantly stay in the market for a set period of time, the entirety of the AM session, or the entirety of the PM session, or the London session. Or if you're really gung-ho about it, the entire session. A lot of people don't have the stamina for that. But I've done things like that. I've conditioned myself to do that. Constantly, I got to be in a trade. If I close, it's only because I'm reversing. You want to learn how to really get a feel for price action? Practice like that. And you will be a maestro in market structure. And you will run circles around anybody else out there that has a title that they work at this firm or this, I'm a Goldman, I'm a this, you're a goober, okay? You can't do anything. Because if you could do it, you'd be out here moonwalking in front of everybody doing it, but you ain't. You're laying on your title. Who cares about that? You're trading other people's money. You don't even suffer the real losses when you have a loss. So what's that really telling you? New day opening gaps. The opening range gap. They're all time-based mechanisms. These things cannot hide from you. And when you strip it down and say, okay, I'm going to look for the setup that runs into a new week opening gap. I'm going to forget everything else that ICC ever said. I can see this happening every day. When you're weak analysis, W-E-E-K, not W-E-A-K, your weekly analysis suggests that we're going downtown for a while, a couple hundred handles. And you see intraday, after a rally in the morning, up, and it's starting to break down, starts to roll over a little bit. Now you see that we're just hovering above a new week opening gap, whether it be this week's new week opening gap or last week's new week opening gap or any one of the last 5. That is a no-brainer trade. They're going to be such an easy ride, low